first tick on the index, and it is 21,500, a 60-point uptick for the frontline index. Sensex 2 opening around 71,560 thereabouts. The advance decline ratio is very, very positive, almost 1,500 stocks advancing to almost 170 stocks declining. So that's something which will be doing well as far as the market is concerned. In terms of the key sectors, it's energy which is leading from the front. So Adani Green, Adani Energy, ONGC, Power Grid, SJVN. These are the names which are doing well. Some of the PSU banking names like Indian Bank, etc. are also perking up. Actually, all the sectors have opened in the green. There is not a red dot that I can find for myself on the screen in terms of individual names. Kansai Nerolac up 9%. Nuvoco Vistas up 6%. SJVN, as I pointed out, continues to trend higher. And then, of course, there are names like Amber Enterprises, JK Cement, Tejas Networks, all of which are reacting to news flow. But overall, Avan, I have to say that it's a solid opening that we have at our hands.
Absolutely, no complaints whatsoever. It looks like the Merry Christmas is only continuing into the last week of the year. So you've got a whole host of stocks within the broader markets as well that are firing away. By the way, there's only one stock on the Nifty 50 that's quoting in the red as we speak. So a firm advance decline ratio at that. And there is a little bit that's looking a little tempered. So for instance, AstraZeneca Pharma, Vedanta, JK Lakshmi Cement, Lemon Tree Hotels, Hero Motocorp, Zydus Life, those are stocks in the red. But other than that, it's gains all across. So let's find out then what our chartist first trades are. And Kunal, at 21,500, what are you punching in?
So I'll go with Wipro as an opening trade. I think from the IT stock, that's something which has been looking attractive. We're bullish on the stock at closer to 430 odd mark. I think now even at 460 approximately for the stock looks attractive from a momentum as well as a positional play.
Okay, Wipro it is. So betting on some of those IT majors to lead the way. Naresh, let's get in your first trade.
So continue like ONGC, which is showing good momentum and is close to a 5 to 8 year high. I would expect it to continue slowly and steadily towards the 230 to 40 mark.
All right, so let's go across to Dinshaw Irani from Helios PMS, who's joining us now to talk more about markets. Dinshaw, morning. Thanks very much for your time. What are your thoughts on the market? So one end of the market is saying valuations are getting stretched, it's getting overheated. The other is saying that party is just getting started.
Well, thank you, Ajay, for having me on your show, and a very good morning to your team and your viewers. So, Ajay, basically our feel is Santa Claus rally is going to continue into the next year, I believe. That's what our feel is. In fact, we were very cautious up to, I think, up to October, because, there were quite a few things which were like triggers for the market. One was obviously the elections, the state elections. But they came out with flying colors. I think the market got more than what it had expected. So that's why that one hurdle was out of the way. And the central elections, it's more or less now decided how that is going to move given the results of the state. The second big hurdle was the way the US rates were behaving. In fact, I think I've said this before also. The fact was that by October, the difference between the 2 and 10 had reduced to some 10 basis points. I mean, the 10-year had rallied up to 5, and rather there was a lot of sell-off in the 10-year paper, and it had rallied up to 5%, which today is down back to around 3.9, I believe. So close to 3.9. In fact, 3.8, 3.9. It's fluctuating between, which was a very good positive angle which was given to the market. I think that also was a big hurdle which went away, and now we also believe that it's time to get into. In fact. When in October we were telling our clients that stagger your investments, today we are telling them to, in fact, straight away in November when the results were out, we were telling them to go lump sum as such. Our feel is that even on the valuation side, given the fact that every single quarter in the last 4 quarter results which have come out, you've seen the upgrades happening in the indices earnings. I don't see this December quarter being any different. I think, again, you'll see some upgrades in numbers because anyway, December quarter was a festive heavy quarter, which was not the case last year as such. So that upgrades will happen again going into this particular next quarter as such. So obviously your valuations, if you look at the last 6 or 7 year averages, we're somewhere there. We're not too far away from this. And why I'm saying 6-7 years is because Demon came on in November of 16, and after that, one has seen only flows coming into the markets and such, and participation was also increased. So that's what our belief is, that we are not too concerned, at least in the immediate 6-7 months as such. But our, again, one strong belief is it's going to be a large cap rally driven by large caps rather than small and mid caps, given that the valuations there look fairly frothy.
So, okay, let's scratch that point a little more. You know, people who just track the trailing earnings have a right to call the market expensive. But if I were to ask you about your own portfolio, what levels in valuation terms is your portfolio trading at right now? I'm assuming it would have run very nicely, comfortably in the last 3 to 6 months versus the earnings growth on a blended basis, your portfolio's visibility.
So, good you asked the question. Our valuations are higher than that of the market, which is the Nifty I'm talking about. But our peg is much lower than the Nifty. Our growth rates are much higher. So, when I say peg is price earnings to growth. Yeah. So, since our growth rates are far higher than that of the index that we're tracking, our peg is far lower than that. In fact, what we try to do is try and keep the peg below 1, because you need to see some upside in terms of, and frankly, I mean, we've been there in the market for a very long time. You guys have been there too. And you would have realized that markets are always slaves to earnings growth. If your growth is higher than that of the index, you'll always generate an alpha. And that's what we try to do. Obviously, there are blips in between, but on a longer term basis, you end up doing that. So I hope I've answered your question.
Hi Dinshaw, this is Anisha also joining in the conversation. We're just discussing how a lot of investors are doubling down on HDFC Bank. I remember having the conversation with you as well, how financials remain one of the key focus areas for you and your liking for HDFC Bank. But the question is, are you willing to double down on your positions at this point?
I think we've already more or less at the peak in our weightages in HDFC Bank. We're close to 10% in our portfolio in HDFC Bank as such. So what you're showing today is the November numbers. After that, it's only been added. I think that's what you're trying to flash on your screen as such. So if you see my December portfolio, which will be out in, I think, a couple of weeks, you'll realize that we've already increased our exposure to financials to quite an extent as such. And we are very comfortable. We are very comfortable given the fact that whenever you, and in fact, that's one thing that we tell all our investors, that what we learn from history is that we never learn from history, but we try to do that. And if you see economies where per capita are moving up, 2 sectors that stand out are obviously financial and consumption. And these 2 are the ones where we are totally heavyweight. In fact, if you, our consumption, if you look at it a broad brush, consumption holding in our portfolio, which would be real estate and tourism and everything put together, we are almost at 2/3 of our portfolio will be roughly what we'll have in these 2 sectors. And we remain quite sanguine about it. We're quite bullish on these 2 sectors.
When you say you've added positions in the financial sector, and we'll see that perhaps in a week, but which are the names? Are you just adding the positions in the current names that you have, or you've added a fresh name as well in the basket? And is it still the private banking names that you like, or diversifying into PSU? Any more color you can add there?
So basically, we haven't added any new names. We added to our existing names as such. Yeah, in terms of the PSU banks, we have the largest bank, which is there in PSUs with us. And we're quite happy with that because it's a healthy mix of the consumption sector. I mean, it's a consumer-facing bank also, and obviously the project lending bank also. More of consumption than projects as such. The big, I think, upside that everybody's looking in PSUs is obviously that they're more of project-related financing. And given the capex cycle that's going to hit the country, maybe that is where the growth will come through. Our concern is on the balance sheet, and that's why we are fairly very careful in selecting our stocks in the PSU basket as such, and will remain so. So we'll stick to our one single name.
Okay, fair enough. Dinshaw, hi, morning. So you're sticking to some of the same names when it comes to financials. What about consumption? It's Christmas, it's New Year's time. Give us some recommendations. Be generous and kind. Any new stocks, it could be across sectors that you guys are looking at or have added?
So Aman, I can't give any recommendations because now we love mutual funds, so we'll stick to that. But the fact is that since you mentioned the holiday season, tourism is going to be a one big theme. I mean, in fact, we're talking about domestic tourism. In fact, international tourism still hasn't hit the country in a big way, but domestic tourism has. And you can already see that in terms of the ARRs. I'm sure you must have I mean, I was traveling a lot of late because of the NFO that we did. Most of the hotels are double their rates. I mean, in fact, more than double the rates. So basically, there's a dearth of quality rooms. And given that the spending power has come back to our consuming public, it's obvious that they look at quality rooms, and that's why it's going to be a stretch. In fact, I think there's another year or two. In fact, what our feel earlier was that probably this will be a peak in terms of ARRs. But looking at how the situation is, we think there's still more growth left in that, and obviously certain hotels are adding rooms, they'll benefit a lot going forward in the next year.
Are you adding those names? These hotels which
Yes.
are adding rooms, are you adding those names in your portfolio as well?
Yes, we are. We are adding.
Sure. Okay. So Dinshaw, on that point of real estate, I mean, every day we are waking up to positive news on real estate. In Delhi, Amrapali is selling a lot of inventory. NBCC is selling Amrapali's finished inventory. In the middle income, Godrej Property is selling massive 48-50% growth in the luxury side in Gurgaon. Where exactly in the real estate cycle are we in your view? Because we've been seeing it for 2 years now already.
So, Ajay, actually, we got to be very careful here because, I mean, we don't want to get stuck with debt-heavy companies because if the cycle turns, there obviously will be that'll be a big pull down for these companies. So we are very careful in our selection process. However, what we've looked at, and in fact, that is what we tell everybody, is that even in the real estate space, you have to look at a company which has a healthy mix of all, not only residential, but also in terms of commercial, in terms of rental, because you need, retail, because you need a healthy portfolio of leasing portfolio, which can be, at some point in time given out as a offering as such. So that's why we be very careful in our selection. In fact, and the real estate play that we have looked at is only a fairly localized play, mainly into luxury housing. So that's what we want to probably do that. I mean, it's based in the NCR, so I don't think you need to guess too much to understand which stock I'm talking.
Yeah, I don't think it needs much guessing. If it's NCR, there are limited players, and DLF is something that comes top of mind. But there are a lot of these, tactical ideas that seem to be popping up. You're just discussing, the chemical sector, which is suddenly seeing a lot of buying interest as well. Would you want to bet on any of these, names for, let's say, a one-year view or something at all, Dinshaw? I know it's a mutual fund, longer term, etc. But there's always that one portion that you keep in for, these momentum plays as well, right?
So, Aman, the problem with the chemical sector is that everybody's betting on the fact that it's a China plus one play. But mind you, China came out of that sector because of ESG, and we also are not too comfortable with these kind of companies. But the fact is that even on the valuation front, they're fairly stretched, and they're yet to prove themselves, frankly. I mean, we haven't seen much of upsides here. So forget about the pricing bit. I'm talking about in terms of financials. So we would rather stay away and then be carried away with this, because there are quite a few ideas. So it's, I think what people believe is they're having a FOMO, I mean, fear of missing out. But the point is that there's so many stocks in the market. In fact, we've seen that consistently around a third of the market does fairly well, and that's like a huge amount of stocks. So we have enough ideas to pick from rather than go in and try to grab something which has just got momentum on the side.
Dinshaw, out of the QSR space, some of the names like Barbecue Nation, Sapphire, or even Devyani has just started moving. Have you looked at some of these names which have not done well? In fact, Jubilant also for several quarters have been complaining about anemic growth in same store and all of that. Where is is it competition, heightened competition? Is it inflation? What exactly has led to such weakness in same store, etc.?
So QSR space is very interesting. I think it's more of the names that you mentioned, which is having a problem right now, is mainly seeing a lot of local competition. I mean, as in you have a lot of options. When you open up a Zomato or a Swiggy, you see so many pizza guys which are there as such, and you would want to try out newer names, right? So I think that's where the problem is. Wherever the QSR is more of say a high street based or say a mall based kind of QSR. I think that's the one which you're looking at, because we have 65 crore youth in the country today, and I'm sure they're always looking at these options of picking up stuff when they're moving around, and impulse purchase as it's called. So I think those are the plays that you're looking at. We have only one player in that space, and I think we're quite happy with that. Plus, we have a supplier who supplies to that player, which is a listed player as such. A part of his sales is through that. Plus, he's got a brand ownership also, fairly well known in the market. So these are the only two, I would say, QSR and its derivative that we have in the market.
That does give us a hint as to which names could be. But, real estate, again, we talked about the entire NCR region and perhaps DLF as one of the names. But what about the entire supply chain? And I'm talking about cement, consumer durables, cables and wires, and the rest of the building material. Is that something that could be an interesting sector to watch out as well, Dinshaw?
That could be, because these are again derivatives, but I mean, in the commodity players that you mentioned, I mean, cement, basically, we do not like that space. We think there's enough capacity and beyond, just because of the price discipline that they have, they're managing to go ahead. And you've seen that, right? There've been pullbacks in prices and all that. So it's fairly not a comfortable space to be in. Or anyway, the players are fairly stretched on the valuations. You can't give out 40, 50 times forward earnings to commodity players. Right? So that's why we're away from that. In terms of the other, like the tile guys and the cable guys, again, our comfort is not there purely because of valuations. I think they've done a fantastic job in terms of earnings growth and all. But even despite the growth, the valuations are fairly stretched in that space and not too comfortable today.
Have you looked at anything amongst the recent listings or the recent IPOs?
No, Aman. Actually, it's been that actually scares us. Frankly, I mean, the IPOs, the way the frenzy is there in that market. I think mainly the retail guys are getting sucked in there because it's IPO, right? So they expect a pop going forward. But the fact is that if that doesn't happen, you at least a very bad taste in the mouth of new entrants in the market. So that may just put off a few. But frankly, I mean, I think the valuations there are fairly stretched whenever the IPO comes. Normally you need something like 20-30% on the table when IPO comes. And when they come at, say, par valuations to the listed entity, or even a premium to the listed entity, there's no way you can look at a pop when that happens. So that's why we've been very careful. We haven't participated in any of the IPOs that have come through of late.
You're right. Dinshaw, I'll just like to go back to some of the supply chain companies to these QSR space. One company which comes to mind is a cookie company, but also supplies buns. I mean, they were to this entire space. But I don't want to talk about their domestic play. Increasingly, in their commentary, one is getting a sense that export could become a big angle for them, or perhaps supplying to some of the really big retail operators in the West, be it Europe or even US. Do you think this could actually be a new chapter for some of these companies and give much more longer term visibility, 5 to 7 year kind of visibility? Right now, exports is a small portion of their business.
No, Ajay, you're right. Actually, that's what excites us about this space also. In fact, I think you're referring to the same gentleman, the stock that we have in our holding as such. But the fact is that, that's the one you're talking about. So, the fact is that, look at it this way. I mean, if India has been the toughest market for QSRs, right? These guys are supplying to MNC players out here. Yeah, and they've been very cost conscious. In fact, I remember meeting one QSR player who was an MNC, and he was telling me that he even counts the number of the seeds on the bun to make sure that the quality doesn't go awry, even though they're cutting the price on the buns as such. So that way, so that's the kind of control these guys have on the cost. And despite that, the players who are suppliers to these QSRs are manage a lovely, fantastic margin as such. So it's obvious that the global MNC will always look at them as a potential to outsource from here as such. So I think that's one thing that we played with. And frankly, commodity prices are the only ones which create a bit of an upheaval, and that's what happened in the case of this particular supplier, because wheat went up because of the tussle between Ukraine and Russia. we waited for the price to correct even before we got in as such, because we realized that was the only overhang for the stock, and whenever wheat prices come into norm, they will go back to their norm. So that's what we waited for, and I think we're very bullish on that stock.
Okay, Dinshaw, on that note, we let you go. Appreciate you making time and speaking with us. But as we are pointing out, it's the IT stocks which are coming back, and probably there's some value that the street is trying to use as far as the IT stocks is concerned. And once that smaller cap IT company has been Sonata Software, this year has been rather good for them. We have seen a solid traction across the board after the new leadership team joined. And of course, the stock has surged almost 30% and close to around 745 thereabouts. I think there was an adjustment which seems to be missing, but we'll watch out for that one. But we have with us the management of the company joining us. We have Samir Dheer, the Managing Director and the Chief Executive Officer at Sonata Software, joining us on the show. Samir, hi, good to have you. The famous adage goes, separating men from the boys. But what has been happening in the IT sector of late is that these boys are now growing into men, with this entire fleet of the second tier and third tier IT companies ramping up now. Talk to us about what kind of journey you have envisaged for Sonata Software, because since you have taken over, there's been quite a bit of transformation already.
I think to your point, this is the season of boys. I think it's probably true, and let me put some color to that. So first of all, I think the market dynamics and the industry dynamics in the last several years, especially post-COVID, has changed quite rapidly. And the change has been predominantly driven by more value, as customers have become much more cost conscious and really pulled back the spending given the broader macroeconomic headwinds that are going on. And that in many ways presents an opportunity for companies who can differentiate in the marketplace and can also be agile at the same time. And that's what I think Sonata is beginning to see the benefit of in the most recent quarters that you probably have seen us. I think our teams have done phenomenally well. And part of the reason is that we have a value proposition that resonates with the customer from a modernization perspective. And we believe most of our customers are in somewhere in the spectrum of modernization over a period of time. Whether they are modernizing their application estate, they are modernizing their customer-facing estate, or they're modernizing their business operations or data platforms. So really, our proposition has been to help customers modernize through our deep engineering capabilities. And I think that message has by and large resonated quite well. Couple that with the agility that Sonata can bring to help transform is really been the differentiating factor. And that reflects in if you look at our most recent quarter that we announced the result, a couple of months back, we have been clocking over 4% growth in the last quarter. Prior to that, another 4% growth. Prior quarter to that, another 4% growth. So for the last 3-4 quarters, we have seen a consistent, 4% growth. Which you put this in perspective, most of the industry peers are growing annually between 2 to 5%. So it is quite a good achievement that we're very proud of. But we want to just sustain the momentum. I think we have started off well as a new management team that has come on board in Sonata in the last 18 months or so. We just want to continue the momentum as we move forward.
Right, morning. Now, just to build on that point, aren't these modernization projects most susceptible to a slowdown in discretionary spends? And do you think that it could continue in terms of momentum? Could that slow down?
Yeah, so I think if you look at the broader market thematic, and let's just sort of peel it by industry. You look at the healthcare industry, the notion of value-based care is still very much out there because the consumers' loyalty to the payers especially in the US is very low. Actually across the globe is very low. So they do not mind flipping from one service provider to another service provider if they get a better price point. So the whole notion is about value-based care in the healthcare industry, and that's really what our main offerings are, to really help the healthcare customers retain the consumers. So while it looks discretionary in spend, but in many ways there is no option, because if as a healthcare company you want to grow your revenue, you have to make sure that your consumers are taken care of. And the same example, if you extrapolate out to the banking side, it is still very much a competitive landscape in the banking world as well, especially as the loans register for most of the banks have dried up, given the high interest rates regime that we are living in. But the consumer spending from a retail perspective, the credit card spending is still pretty robust. And I think that's where most of our offerings are in the retail banking space, and the Quant acquisition really helped us accelerate the journey. And hence we see a continued momentum in that time frame in there. And juxtapose that with the fact that the technology is rapidly changing as well, and customers are really looking to embrace the newer AI models, the newer techniques and tools that are out there to really help build a stickiness with their consumers. And hence the whole modernization template that we have created is an ongoing process to a large extent. You move from one point to another point, and then by the time you reach to second point, there is a journey to be had to further evolve from there on. And hence, yes, it's a discretionary budget, but it is almost like a mandatory budget from customers' perspective, because they cannot do without the growth that they're aspiring to have.
Right. So would you say that the decision-making cycles also have eased a bit, because you did talk about closing at least 10 to 15 large deals in this year itself? Is this something which is on track?
Yeah, so we feel pretty confident with the track record that we've had, that we can continue to clock away the large deals that we have been talking about. If you look at our past track record, I think practically in every quarter for the last 4 or 5 quarters, we've had announcements of about 2 to 3 large deals. I think there is no reason for us to believe that trajectory will change. I think we feel pretty good about that. Now, of course, there will be an odd quarter that we might close more, and odd quarter we might close less. But on the whole, the 10 to 12 large deals in a year, I think, is still very much a doable target for us, and that's what we are working through it. But let's keep in mind also the macroeconomic conditions are rapidly changing as well. So this is, as we sit here today, is our best estimate. As things change, and we're keeping a very close eye to the market situation and dynamics, we believe we'll make adjustments accordingly. But as we sit here today, we think that's definitely a doable goal for us to have. And if you look at the announcement that we have made, we announced some fairly large deals in the course of the year. We announced our largest European deal. We announced the largest deal ever as a company. And that's been the trend that we continue to see, because as customers get on board with the modernization thinking, the agenda for doing long-term projects just increases dramatically.
Sure, but I also wanted some clarity on the margins and the pricing of the contracts. Now that the supply side pressure of attrition and retaining people is going away, is there some sort of benefit that you're passing on to customers and reducing the pricing at all?
No, I don't believe so. I think if you look at in the most recent quarter, our EBITDA performance was very strong. We don't think there is a pricing pressure. And I think it sort of goes back to what your company stands for. I think in the area and realm that we operate in, which is modernization engineering, I think price is less important for customers. Value is more. And there is a fine difference between the two. If you're delivering the value for the customers, they tend to focus on the outcomes than the input metric, which is price. And that's what been the trend. Now, having said that, as a company, as you've probably seen this in our past announcements, we have said that between 1.5% to 2% of our company revenue will spend in our investment thesis, because we are breaking open new markets, new capabilities, new technology areas. We called it out that we will invest about 1.5% to 2% over the next couple of years till the time we get to our stated goal of about 1.5 billion as a company. We'll do that, but that's nothing to do with the pricing pressure. That's a very deliberate investment strategy to really build scale. And it's an extremely important activity we took on, if you recall, 1.5 years back when I came on board, because when you build scale post the growth, you always have a problem. So in many ways, you have to build scale ahead of growth so that you're ready for the growth that you're going to get. And that's been the thesis with which we operated. And we believe we'll continue to operate that, so that we are setting the company from a scale perspective. And scale has many facets. The scale is in terms of really hiring salespeople at one end, hiring technologists on the other end, geographic expansion on the third end, vertical expansion on the fourth end, solution expansion. So many facets of this scale. And we're really quite bullish about the fact that specifically the progress that we have made in the newer areas like Gen AI, I think those will continue to help us scale the company in a very meaningful way, and hence really provide a value-based offering to our customer rather than a price-sensitive outcome to our customers.
All right, so do you think that margins, they'll be in the 20s range broadly?
So our stated objective has been that we want to get to 1.5 billion at a corporate level revenue on a run rate basis by FY26 end. And that will comprise of 500 million coming from international business and close to about 1 billion coming from the domestic business. And for the international business, we have stated we want to be low 20s EBITDA. And I think we're pretty confident that we can hit that goal by the time we get to FY26. And we are already at 22, 23%. I think we'll be around 21, 22, even 2 years out, despite the investment that we're going to make.
Sameer, the third quarter furloughs have been higher than usual or the same, if you could clarify. And also, secondly, what are the risks that you're watching out for from here on for the sector and for your company?
Yeah, it's a great question. So again, multiple parts to your question. Let me try and unpack it. So number one, do we see the momentum continuing? The answer is absolutely yes. What we are worrying is pretty much in line with what the industry is worried about, that the macroeconomic environment is A, very scattered, and B, little confusing right now. While we are seeing good growth momentum go forward, but everybody's trying to piece what is happening in the macroeconomic, right? I mean, the inflation is beginning to come down. The interest rates are still high. The unemployment in US at least is almost at an all-time low. So to piece this data together and say what the next year looks like is quite difficult and challenging. But we just, in these times, we just focus and stay close to our customers. And what we are learning from our customers is that their budgets are either flat to slightly up, which is a good sign. That means it's another year of opportunity for Sonata to pull ahead and take wallet share away from our competition, which is what we have done in the last couple of years that we've been talking about. So we believe this will be hopefully a good year ahead for us, and we can take more market share away from our competition, even in an environment where the budgets are either flat to slightly up. So to the last part of your question, what is keeping me awake? I think that whole agility to respond to the market is something that we calibrate often. It is an exercise that we do quite regularly to see are we investing in the right areas, because we take the investment that we have planned about 1.5% to 2% quite seriously, and hence the recalibration of that investment literally every quarter is something that we do, while the broader vision of modernization is absolutely profound and there. But as the large deals inflow is increasing, we have to keep calibrating about our conscious choice we're making from the investment thesis perspective, coupled with the larger macroeconomic situation that we are in, so that we are absolutely sweating out every dollar that we're spending from an investment thesis perspective for the benefit of Sonata as well as our shareholders' returns.
Okay, and shareholders' return is something which has been good. Sameer, on that note, we let you go. Appreciate you making time and speaking with us. But time now to slip into a very short break. As we do that, a quick check at some of the stocks. 3M India has actually perked up 6%. Fine Organic is the other one. It wasn't moving yesterday. Today, it's actually catching up. And Shriram Pistons is the other one that continues to gain after that marquee investor had checked in. So 5% gain today as well. And the cement pack, Nuvoco Vistas, etc. are some of the stocks which are holding up in the green.
And one interesting stock which we missed discussing was Indiabull Housing. That stock actually goes out of F&O this series. So it will become a cash stock. And who was checking into the counter yesterday as per bulk deal? Matthew Syriac. Matthew Syriac bought some 5 lakh shares yesterday. The stock is gaining by almost 3% in trade. But we'll come back with very interesting management on the other side from the pharma space. So don't go anywhere. All right, so pharma as a space is showing a lot of promise. Last couple of days, stocks have shot back. Even Wockhardt Pharma is in focus. The stock, pull up the last 3 month or 1 month chart, you would see the kind of price action that stock has done. There's a lot of developments also happening there. Dr. Habil Khurakiwala, founder chairman of Wockhardt Group, is joining us now to talk more about some of the new recent developments out there. Mr. Khurakiwala, thanks so much for your time. Good to see you today after a long time. Let's start by, this phase 3 study on nifty for pneumonia, which has been completed at your end, at the company's end. Talk to us about when will be the product launch happen? What is the timelines from here on?
Thank you very much, and good morning to all of you. Wockhardt has been involved in drug discovery for last 25 years. And nifty just completed phase 3 clinical trial in India. And earlier we had completed phase 1 and 2 clinical trials in US and Europe. Now we will be filing in next few weeks to drug controller, and we expect to receive approval sometime in the mid-24. And then after it will be marketed in India. We will also simultaneously apply to various emerging markets. And we expect that after about 9 to 10 months, we should be in additional market than India, basically. And this is a very specific product for pneumonia. And it is an ultra short treatment for 3 days only. And it has nearly 97.4% success rate in the clinical trial. And it works where older drugs like azithromycin, enoxiclav, they do not work. And there has been in India resistance to the extent of 20 to 30% of pneumonia with the older drugs. So doctor has to ultimately go to injectable treatment, and that could be avoided here. And an oral treatment will suffice the treatment.
Sure, Mr. Kurakiwala.
Yeah, please go ahead.
No, kudos on that, on this research, and the fact that it's a 3-day treatment is something which is very good for the patients as well. But could you help us identify the opportunity size of it as a whole? You talked about how you're looking at launching it in India as well as a lot of other international regions as well. But collectively, what could be the opportunity size, you believe?
The opportunity would be enormous, especially when you go to specialists like chest physician and pulmonologist. And we intend to market this, and we might look for some of the partners in marketing in India and elsewhere, where we can expand the usage of this rapidly. And the incidents are so high, they are in millions in the country. And therefore, we expect to have a good sizable market in terms. And we have not yet fully assessed the market size. We have some rough idea, but I think once we have the clarity, I will be happy to communicate.
Kurakiwala, hi, morning. Can you give us a sense as to which are some of the other products in the pipeline and what the status is on the QIDP, the status on WCK 5222 and 6777?
The WCK 5222 is our best product, and it deals with gram-negative resistance organism. And it is undergoing phase 3 clinical trial, and which will be over in next 4 to 6 months. Simultaneously, we have also applied to the Controller General in India for potentially emergency use for a clinical trial, which is specifically focused on meropenem resistant cases. And we hope that we will complete this clinical trial during the year and probably be in the market later part of the year for the possibly emergency use, I must say. Additionally, there's a compassionate use clinical is going on. And so far, we have completed 13 patients on a compassionate use with a 100% success rate. As far as this is a third drug, 6777. We have completed phase 1 clinical trial, and this was conducted by NIH USA. And we would be proceeding with phase 2 clinical trial later part during the next year. This is the only once-a-day antibiotic which will be available. It is also gram-negative and works on the resistance cases. So once-a-day antibiotic would be very useful when the hospitalization is short period of time of 3 or 4 days, and the drug can be continued for additional 4 or 5 days. So from patient convenience point of view and the cost management point of view, overall, it has its own position and a niche in the market.
Sure. Mr. Kurakiwala, I also wanted to talk to you about what's happening with respect to the contract manufacturing opportunity as well, because that's something that seems to be coming for the company. Could you talk to us about what's the capacity utilization you have right now? What could be the prospects for contract manufacturing for you, and what could be the size again?
We have already, as we announced earlier, signed agreement on a profit sharing basis and contract manufacturing with Serum Institute to make vaccines in our UK facility. This is a long 15-year agreement, and we have earmarked capacity for 150 million doses for them. And we expect that the moment they sign that complete a clinical trial for some of the licensing arrangement they have done. And they've identified 2 of those products. So we hope that later part of the next financial year, we may start the process of production. That we are also in discussion with another company, a global vaccine company, for also contract manufacturing opportunities. As and when it is inked, we will make an announcement.
Well, in fact, I wanted to just have a quick follow-up on that one. You may not wish to divulge the name, perhaps till things are completely signed, but I want to understand which facility is it for? Do you have spare facilities? Is it in India or in the UK, or which line of manufacturing will it be, or category?
This is a facility in UK, our operation, and it is also for vaccine manufacturing facility. Additionally, and we have currently the capacity to do that, but going forward as the business develops, we will further add the capacity.
Okay, and also with respect to the diabetes treatments, what's the R&D happening in that segment? Because I was reading up that you are doing a lot in terms of the newer diabetes treatments as well. Any update you can help us with?
In a diabetes space, we believe that we are one of the few companies in the world, other than innovators, where our competitive space is limited and we have a competitive advantage. And therefore, we are focusing on newer insulins like Aspart, Lispro, and we plan to develop and launch these products over next 4-5 years. In most cases, the patent is off in next 2 years or so in emerging market, and that would be our immediate foray. Just to get you a sense of it, today for these products which are getting off the patent, the emerging market itself without US, Europe, China, and Japan is nearly $5 billion. So it is a great opportunity we see because we have advantage, because we are there in insulin, we are there in glargine, and we have a large number of partners in emerging market, and therefore to add new product to these partners would be possible, and we would be very cost competitive because of complete integration right from the API, the drug product, and even the device, our own patented device is there. So that is also done in-house. So that's our strategic advantage in this space.
Akivala, before we let you go, what's that big thing that we should watch out for, work hard for the next 1 to 2 years? What are those key things in the pipeline that you think can probably cause a bit of a re-rating? Anything specific to watch out for?
One would be our launch of nifty in India. It would be a big event for us. The second would be completion of clinical trial, a global phase 3 clinical trial, which will lead to filing US and Europe, and that would be probably the first Indian company having a drug in the global market. And I believe the third would be getting the new clinical, which we are starting with the Drug Controller of India for meropenem resistance cases. This would be a big event, mainly not only because of the business opportunities available, but it saves hundreds of lives every month with the introduction of this product.
Sure.
And thank you. Yes.
Sorry, Mr. Kurakiwala, we'll have to let you go because it's 10 o'clock and there are 3 listings on the bosses that we have to address. So thanks so much for making time and speaking with us. But let's take a look at those big listings that we are expecting today. Credo Brands, aka Mufti, Happy Forgings, as well as RBC Jewelers. All of these 3 companies have listed on the bosses, and let's track what the prices are as well, because there was value on the table for some of those brands, especially Credo as well as RBC Jewelers. Has Street given a thumbs up to that? And is that something which is showing in the listing price as well? Is something that we should watch out for. Let's see how the listing has actually happened. So Happy Forgings has actually seen a good listing, 14% gain, while Credo and RBC are pretty much tempered, flattish to a bit of a negative opening.
Despite of which appeared to be very fair valuation, the street is not giving them a very massive kind of a premium as far as the listing goes. But we'll talk more about the business outlook from here on. Happy Forgings appears to be 15%. I think investors will have to be happy in kind of a softish 15%. I mean, these days IPOs, people who are getting allotment are getting very good, kind of pop on the for a flipping opportunity. Let's see if Credo and RBZ actually get follow-up buying. The point which we discussed versus the valuations right now. 18 times 1 year forward if you are an IPO holder, and slightly higher, 20 times if you are buying now. And RBZ, of course, mid-teens. Let's see how the session actually goes from here on.
Yeah, while of course compared to the other two, Happy Forgings has had a pretty decent listing. I don't think, Ajay, it's up to mark with what the expectation was. I think they were looking at maybe like a 40 to 50% premium. So in comparison to that, it's not good. But yes, of course, there was strong interest that was shown as well to the public issue. So it's not entirely unsurprising. But yeah, is there going to be any follow-up with Credo, with RBZ? Looks like it's absolutely not wavering as of now. But I guess the rest of the day and our interaction with the managements will only cement that. Okay, tell you what, we'll take a very quick break then right here on the show. Don't go anywhere. We've got lots more interesting corporate voices lined up.